So with that, I'll just introduce SGX Director for Securities and Trading, Wei Chin. So of course, he is the expert in ETF. Feel free. We're actually going to let him speak for about 30 minutes, and after that, we have 15 minutes of Q&A. So please take this opportunity to ask questions. He is definitely the man to answer all the questions you may have on ETF. So take this opportunity. You don't get to speak to him so often. So with that, let me just pass the stage over to Wei Chin. Okay, Wei Chin, please. Thank you so much.
Yep, thanks, Yimin. And it's an honor to be invited to your investment sharing session.
Thank you
So
so
my name
much.
is Wei Chin. Can you hear me? Yeah, so my name is Wei Chin. I'm the ETF product manager at SGX. So my role is really to work with the ETF product issuers to bring on more new and innovative ETFs on SGX, and of course work with the brokers and securities houses, including partners like Emin, to advocate and educate investors on these newer launches. But of course, today's the main objective I'm here is to share with you a little bit more on what's the latest development in our ETF market. And I understand from Yiming, most of you would be kind of familiar with ETF already, but I'll probably start with 5 minutes on ETF basics, and then I will go into some reasons of why ETF makes sense, why you should not only look at one or two ETF, but a couple of them makes more sense over long term. And last but not least, I'll just give a very brief intro on what we have on our market today. So give me a second. I'll be sharing my screen. Should be on presentation mode now. Just a disclaimer. What I'll be sharing is not an advice to buy or to invest in any of the securities. Please always seek independent advice for your financial investments, and also any of the numbers or returns we show of historical performance is not an indicative of their future performance. So with that, I'll be moving on to the next slide. Just some basics of what's ETFs, in case any of you have not invested into any of them. It's really a hybrid between a fund, which is in the market for longest time, allow you to have a diversified portfolio of securities. It could be stocks, bonds, or REITs, and we put it on the exchange so that you can trade throughout the day. Three key reasons why investors are looking into ETFs. E stands for efficiency, T transparency, F for flexibility. So efficiency, we are really looking at the cost efficiency. For those of you who have invested into other investment vehicles, such as unit trust, you may have noted that the fees does matters over time. I think investment lessons, we know that you should continue to stay invested because your investment returns will compound. Even your returns, your fixed deposit in your bank account will compound over time. But same goes for fees. So fees, if you pay excessive fees for a long period of time, you realize that that can amount to quite a big sum over time. And we're talking about if you invest $1,000 a month, assuming you're paying 1% more in fees, technically you will be losing out over nearly 15% over a 28 years period. So do not let your fees compound, and ETF really brings you the convenience. And most of the ETF today, as Emin has shared, we have launched a couple more new one over the last 1 year. In fact, most of our ETF, over half of them were launched over the last 4 years. And some of our ETF that were newly launched has a basis point of less than 20 basis. Some of them 18. The lowest one we have on SGX is 9 basis point. So these are the ETFs that will help you to save in your cost. And if you look at how this will help you as well, if you are using STI ETFs, because of the low cost mechanism, currently our STI ETF is only on 25 basis point for one of them. Over a long period of time, in fact, if you look at recent years from 2019 till now, you can make a 6.5% returns per annum. So that's quite close to the illustration that we have shown earlier on. Of course, as mentioned, historical performance is not reflective of the future performance. Price transparency as well. So unlike mutual funds, whereby when you buy a subscriber mutual funds, you only know what you're getting probably a few days later, right? Because you can only indicate the amount you want to invest. You don't know how much are you buying the securities for. But ETFs is different. You can buy on the real-time market. You can buy throughout the exchange opening hours, and that allows you to know exactly what price you're paying for. And this is critical if you are coming into rebalancing of your portfolio, because assuming you want to reduce your exposure in one market, for example, the US market, and you want to increase exposure in the Singapore market. ETFs make sure that you don't need to redeem and then subscribe a new fund over a few days period. You can do it within the same day, within the same hour. Right, and just one piece of education to the audience. There are two forms of values that you should always take note of when you are you're attempting to trade the market or enter or exit your market. Two values. Normally they are published on the issuer website. One of that is end of day NAV. When we call NAV, it means that what is the portfolio value yesterday after market closed. And there's a number called INAV. INAV is refresh every 15 seconds throughout the day. So assuming you're trading at 2 p.m., INAV is the value that you should take a look, because it refresh every 15 seconds during trading hours to make sure that you do have a value in mind on where the portfolio should be valued at, which also means that your bid-ask spread should not deviate too far from the value. Flexibility, I'll spend a bit more time on this, a couple of slides. ETFs also allow you to diversify across multiple assets. So ETF started, one of the earliest one was S&P 500, allow you to buy into 500 companies in US. The first one in Singapore was STI ETF, 30 blue chips company in Singapore. But since then, ETF has evolved into a vehicle for other asset classes. That includes bonds, money market funds, include REITs, and one of the most popular we have is gold ETF, right? So ETF is no longer restricted to stocks. You can complete your investment portfolio using ETFs to cover each of the markets. And fixed income bonds is the one that has really grown a lot faster in recent years, right? So what are the strategic use of ETFs? We mentioned earlier on, you can build a core allocation. Your retirement portfolio can be built using ETF. You can use it more tactically, meaning that assuming you have your core built, for example, you have your Singapore equities, foreign equities such as US equities or China. You have your fixed income bonds and maybe some allocation to gold, right? You already built a core allocation, but you feel that the certain sector is undervalued now. For example, tech sector, you can use ETF to increase your tech exposure. If you want, I think one of the ETF that Emin will be sharing is Asia High Yield Bond. That could be a tactical play as well, assuming you feel that the high yield bond market is going to perform well over the next 3 to 6 years or 1 to 3 years, short-term play. You can use tactical allocation as well. Sometimes we call it satellite fund as well. It can be some of the markets that want to allocate 5 to 10%, not too much. That could be a tactical allocation. Income generation. Depending on the purpose of investing, before you even invest, you should always have a purpose in mind. Assuming you do have sufficient capital for retirement, you do have built up a large base. Your intention is not really so much going after growth, but going after regular income. ETFs can be used as an income generation tool as well. We do have ETF that pays above 4% dividend regularly. Most of them would be bonds and REITs. And that includes STI ETF as well, which pays about 4%. Global market access, as mentioned earlier on, you can buy into US, Japan, China, in fact, the whole of Asia. That's one of the ETF that has lower TER on our SGX on the market. You can really access any markets in the world, most of the market in the world using ETF. Climate ESG, this is something of a recent trend. So for those of you who have been following the news, the need for climate action, and you do want to future-proof your portfolio using the climate overlay, that's something you can do it via ETF as well. Last but not least, many times you may not need to trade on the ETF to look at its prices or its trends, right? Sometimes ETF can be on a watch list so that you have a sentiment of where's the market moving for certain sectors. So most of the time, an investor would need to know what is their portfolio they're trying to build so that they can fit in. I think Emin was trying to share as well. We have over 40 ETFs. So what role does it really play? I think it really depends on one's investment portfolio. If it's a growth oriented one. So how much are you going to put in equities, bonds, REITs, or gold, so that you can balance out your exposure. And within equities, you got to have a think as well how much you want to keep it as Singapore, such as STI, or how much you want to invest into overseas market. Right. So this is a good example. The indices I'm showing here, they would have its own version of ETF on SGX. For example, on a 60% of equities, if your intention is to invest into a wide spread of equities market, we do have beyond STI ETF, the S&P 500 index, MSCI China, Asia X Japan X China. This is a very new product that was listed in April, which allow investors to take China out from their Asia exposure. One of the reason being China is really a big market of itself by now. So this index allow you to expose yourself to key markets like India, South Korea, Taiwan. It was launched by Nikko Asset Management. Last but not least, I think I mentioned earlier on, if you want the climate focus ETF, we do have one that invests into Asia ex Japan market. So the core market of this ETF would be India, China, Taiwan, South Korea, Singapore, Hong Kong, and Southeast Asia. Bonds, we have different currency based. Among the most popular ones among retail investors would be the SGD denominated ones. The first one is IG non-sovereign. It means that it's largely corporate bonds. Duration is about 5 years. The yield is about 3%. So this is really for investors who are going after corporate bonds. But they might find a quantum of single issuance too big to subscribe because some corporate bond might be in quantum of a few $100,000. So this ETF allows you to access to a wide range of issuers. And a lot of the issuers are in fact the local stat boards. ABF Singapore Index. This is predominantly Singapore government bonds. Duration is about 9 years. So if you look at the underlying holdings, these iBox ABF Singapore bonds will have mainly Singapore government bonds. We do have China government bonds as well. And last but not least, the index of Asia USD high yield diversified credit. It is the index for the ETF that E-Min will be sharing in later part of these presentations. REIT, I think this is one of the key favorite of our local investors. Last year, the combined asset management of these asset class of ETF has crossed 1 billion Sing dollars. Among them, the more popular ones are Asia ex Japan REIT, also S REIT. So why Asia ex Japan is getting more popular? I think it cater to needs of investors who wants to add a little bit of regional REIT to their existing Singapore REIT exposure. Asia ex Japan would means that you are getting exposure to some of the Hong Kong REITs, such as Ling REIT, which probably you will have seen them in they are probably around in some of the malls in Singapore as well. And last but not least, I'm not sure if most of you have been following the news on gold, but it certainly has been one of the top performer over the last, I would say 2 years plus. Last year, it recorded over 20% returns. Year to date is another around 20% return as well in Sing dollars term. So this has certainly caught the attention of a lot of investors. So together with these different type of ETFs, that's how really investors can start to build a more diversified investing way. So I have a few more slides on that topic. So some of investors will be thinking if the highest return I can get is from equities market, and some have specific interest in certain market like US. So why the need for diversification? One of the main reason is always you want to make sure that your portfolio is stabilized. It gives you stable returns, not only on the very long term, like 10, 20 years, but also in the near term, 1, 3, 5 years, can you really achieve a more stabilized returns so that you don't have too much sleepless night, maybe if one of the asset class or market has a sharp sell-off, so that you can really stomach your risk even on a short-term period. Right, so I have put here example of two of the portfolio. One is 60-40, 60 equities, 30% in bond and gold, right? So this is considered a bit more moderate, but towards equities type of portfolio. I'm just using a very simple example. Although it got over 40 ETFs, I'm just going to use 4 of the underlying. First one will be very familiar by all of the audience, our Straits Times Index. The second index will be the S&P, US S&P 500 companies, which includes the Max 7 companies and the other 493 US large cap companies. Singapore more bonds to act as a stabilizer, and last but not least, gold, which is, as I mentioned, is getting more popular, and investors do use them to diversify your portfolio basket. So if you look at this portfolio, right, obviously the bars that I've shaded in green, it shows that it has kind of delivered above the average returns. Those that are not shaded, it has in fact performed under the average return of the portfolio. So if you look at from year-to-date returns to 10-year, the portfolio can varies across each of the asset classes. For example, if you have invested in STI from year-to-date to a 5-year period, you have sort of outperformed the average returns. Whereas if you are invested into a pure Singapore bond portfolios, you are likely to have underperformed most of the time, except for year-to-date, right? So this is really a reason why investors would want to keep their portfolio diversified across local, foreign equities, bonds, and gold. One interesting fact, of course, if you look at gold performance, because of the recent rally, it has really outperformed the average returns over the from near-term to long-term period. And that also proves a point where gold over a period of time, it does helps you to diversify your portfolio returns. Another example would be less heavy on equities. Maybe you increase your bond portfolio as well and maintain your goal at 10%. Why 10%? 10% is typically a maximum allocation advocated by be it the World Gold Council or the maximum limit that CPF OAIS allow for. So assuming you put 10%, this is roughly the portfolio mix that you will arrive with inclusion of Singapore equities, US equities, and bonds. So you can see you don't really get a super high returns over 10-year period, right? So one of the argument is that if I can get a much higher return over a longer term, then why bother investing into other asset classes? Although you see that the 10-year historical return for, say, S&P 500 is 12.7, there is no assurance that it gives you 12.7 every year or even for the next 10 years. As investment advisors always say, past performance will not indicate its future performance. And if you have solely invested into a market like S&P, you may have disappointed. You may have been disappointed over the last 1 year and year-to-date, where it has significantly underperformed STI. It has also underperformed the bond market. So the beauty of really staying invested, if you look at earlier slide, is really to achieve an average return that help you to cruise through, be it your short-term or your long-term performance. So we'll just move on quickly into Singapore listed ETF. So I'll give you a bit of color on what are the latest development in our market, right? So if you look at beyond the 4 funds portfolio that I have shared earlier on, your choices is really not limited to those. In fact, if you look across the REIT market, this is something I didn't include the model portfolio because I wanted to keep that example a much simpler one to digest. But if you look at REIT, we do have a growing number of REIT ETFs. More traded ones these days are CSOP, S-REIT, also Lion Philippe S-REIT. For those of you who wants to go beyond Singapore REITs, Nikko and UOB, they do have a regional REIT ETFs. And then if you're moving into the Singapore equity space, we used to only have STI, but in recent years, issuers has also been active in launching more products. I'm not sure if you have heard of the Lion OSPL Singapore Low Carbon. This is an interesting one. Besides having a low carbon, meaning that they target companies that have lower carbon emissions, this ETF also captures the growth of overseas Singapore company listing, such as Sea and Grab. These constitute about 15% of this ETF, which is quite significant if you want to gain access into markets, into companies, Singapore companies that are not listed on SGX. Last but not least, Sing Income. This is a very interesting ETF as well that offers investors higher dividend yield. It does screen through companies. It's a bit of smart beta ETF. It's screen company with good quality financial health, and most importantly, is dividend focused. Regional wise, so beyond Singapore, if you're looking at our neighboring countries, these three ETF all offers you a very degree of access into the regional markets. The two giant, obviously, in the emerging market will be China, India. But if you are looking to invest into Japan or Australia companies, you can go into the FTSE APAC Low Carbon that offers you access to this market as well. Last but not least, one of the most recent launches we have is the APAC Financials. That was launched in last year, and it has achieved a pretty stellar performance in recent months, largely due to the outperformance of banks in this region. So over a 1 year period, it returns about 30%. That's about 3 times higher than the APAC-wide broad-based index returns. Of course, global. To date, some of the investors still do not know, but we do have a cross-listing of the S&P 500 ETF on SGX. Ticker code is S27, and that has been cross-listed for over 20 years. It is, in fact, one of the most traded ETF for those who are investing using SRS account, because for SRS, this is the only S&P 500 ETF that's eligible for investing. On the right side, you can see besides gold, we do have a wide range of fixed income products that includes Singapore dollar currencies. The example I have shown earlier on was the Singapore government bonds, which is ABF Singapore Bond Index. For those of you who are looking for a higher yield, probably you should look at the one you should look at is Nikko SGD IG. IG stands for investment grade corporate bond. Both of these are investment grade, meaning the risk of defaulting is lower than most other lower credit rating bonds. Of course, we do have other currency, USD for investors looking for USD exposure. Most of the time it's for higher yield because you look at the current T-bill rate in Singapore, it's about 2.2. Fed fund rate is way higher. So if you're looking for yield pickup, some investors may pivot to US. Of course, the caveat is you will be exposed to the dollar sing risk. So just to sum up the shelf of products we have, you can divide it into 3 key pillars across asset classes. Singapore, we do have a wide range of equities ETF available. For those of you who are looking for leverage and inverse factor, we do have 2 that are launched by Philip, offer you a more leverage and inverse. This is SIP product, so make sure you are SIP qualified before you attempt to trade on these products. Fixed income, REITs. China, we have about, by now we have 11 ETFs that tracks China equities and 2 bond ETFs. We'll talk a bit about that later. Regional as well. So apart from US markets, these days we have launched a lot of regional market ones. For those of you looking for Japan exposure, we do have an active ETF that tracks into Japan equities. And as of April, it has in fact outperformed the Topics benchmark. So that's by Lion Nomura Japan Active ETF, ticker code JJJ. So that might be something worth looking at. So just to share some of the stats, the numbers, these are the markets we offer across equities, fixed income REITs. The top 10 traded ETF last quarter was Hang Seng Tech, remained the first, followed by Gold, Straits Times Index, S-REIT, right? So I think Emin probably have shared the same thing. REITs and STI are the key products that investors in trading. But you can see that there are some other products that made the list, including high yield bond, climate action, as I mentioned. So iShares Climate Action is quite a new product. We'll talk about it later. Last but not least, S&P 500 is also among the top 10 ETFs. Top 10 performing is something has happened in the past last quarter, but you can see that Singapore remains strong with Sing Income and also STI among the list. Top dividend paying, that might appeal to investors looking for higher yield. This just shows the average dividend yield over the last 12 months for these ETFs. So I'm just going to talk a little bit about the one I mentioned earlier on, iShares MSCI Asia Climate Action ETFs. This is in fact the second largest ETF we have in the equities shelf after the STI ETF. Why it has garnered so much traction globally? First, besides its large fund size, it has also a total expense ratio of only 0.18%. It is the cheapest TR globally with Asia ex Japan exposure. And this also means that it helps you to reduce the fees that you compound over time. In fact, if you look at since inception and 1 year total return, this also has outperformed its parent index, which tracks the MSCI Asia ex Japan. You can look at here the holdings, the country exposure is very diversified as well. Of course, the two giants are China, India, but it do have quite a fair bit of allocation into Taiwan, Hong Kong, South Korea, top 10 holdings. Besides the Chinese companies, you do have quite a few names from Taiwan, including TSMC and MediaTek, which is the key semicon IT companies in Taiwan. I think I shared earlier on, we do have a large shelf of China equities ETF these days. So really, when you're assessing the China market, beyond Hang Seng Tech, which most of you might have heard about it, given it's the top traded name, there are other Asia's options that cover the broad-based Asia market. And of course, if you look at the top names, it will be the liquor company like Moutai Wuliangye, CATL, BYD. These are more of the Asia's heavy companies. But those of you who might be looking more for tech focus, meaning because of the news that China is dedicated to building its chips capability, AI capability, you want to do allocation to the more growth focused stocks. There are also a couple of them that are very growth focused, including those that tracks Star and Chinex, which are supposedly to be the next up and coming Nasdaq spot in China. Dividend focus. In fact, this is the most recent ETF that we have launched. I shall share in the next slide. This is the Lion China Merchant CSI Dividend ETF, one of the most recent launch. So why is this being popular among the retail investors today? Largely because of the high dividend yield that it has able to achieve, and also the names is a lot more diversified. You can see the top holdings here is about 2.5%, and these are companies that are really not found in most of the for example, for CA50 index. So for those investors who wants to invest into China beyond the large cap, and you want to generate strong dividends, these ETFs allow you to do so. I'm just going to go back a bit on the Asia High Yield Bond, right? I know that Yiming will be sharing with you on this shortly, but I just want to share with you some color on this product as well. This product was launched probably by now more than 15 years already. Its AUM was about 70 plus million USD for almost a decade, right? It really has picked up in adoption in sometime on late 2019 to 2020 onwards, largely because of the low rates environment. Then investors were looking for a vehicle with higher dividend pay. That being said, it used to have a very high allocation into China property market. At its peak, it was 40% into China property. And those of you who have followed the news in China, you do know that there was a kind of credit debt issues then in some of the property developers, and you name of Evergrande Country Garden. And that has resulted in quite a sharp drawdown in the value. It was trading at $10 NAV. You can look at the chart on the top right, and then it was $10. It has fell to as low as $5. Now it has stabilized at about 650. So what has changed since then? China property now make up about 3 to 4%, down from the peak of 40%, and it has become a more diversified company, with about 17% in China, 17% in India. Japan is about 14%, and the rest are diversified across Asia countries. Which explain for the more stable, if you look at the chart on the top right, the more stable net asset value, as shown by the blue line. In fact, it has been a steady increase from $6, now it's about 6.70, and also the gross yield, it has been quite stabilized, showing by the green bars. It has been hovering between 7.5 to 8.5% since 2023. Which I think it could be a reason why I guess Yiming find interesting to share as well. Again, do bear in mind, this is a high yield bond product, meaning that most of the bonds in the basket are non-investment grade, right? Or it could be non-rated bonds. But the beauty of then investing into a high yield bond ETF is that your risk is diversified across a few hundred issuers, and you're not subjected to a single high yield bond issuer risk, which can be very risky because you're investing into a one high yield bond. Once the issuer default, you face a total loss. But if you're invested into an ETF with over 100 issuers, if there are a few of them or one of them defaults, your loss can be buffered by either the price gain of other bonds or the dividend that is paying out from the fund. So that is really a reason why high yield bond is always riskier if you buy into a single bond compared to a high yield bond ETFs. I think I have one more new listing to share as well. This was what I've mentioned earlier on. Imova. Imova, for those of you who do not know what it means, it will be a name change for Nikko Asset Management. So by September, they'll rebrand themselves as Imova. But before that, they have called this ETF in April, Imova as well. One thing unique about this is the first ETF globally that tracks Asia ex Japan ex China index, meaning that in this portfolio, you don't have China, but you have most of the other Asia countries excluding Japan. One thing that caught my attention is probably the exposure it has to semiconductor related companies. If you look at the table in the middle, TSMC make up 17%, quite significant. It's almost 1/5 exposure. And beyond that, you have a lot of the others, semicon related companies like Samsung Electronics, MediaTek is here, Honda is here. So together, this is quite a heavy, I would say very heavy allocation to tech companies, about 37%. So for those of you who already vested, I would say into probably US tech or China tech, this ETF allows you to capture the regional tech companies exposure. That is really the key characteristic of these ETFs. The manager has also capped the total expense ratio. So management fee you can see is 50 basis, but they have capped the total expense ratio to 60 basis, which kind of limit the fees that you pay to the fund. Just one last slide on the ETFs we have, REIT ETFs, which I think Emil will be talking about REIT later. But as a whole, our market has been resilient over the last one year, and the investor has been continuing buying into REIT ETF to gain exposure in the market. If you look at the dividend yield, it has been quite stable as well. For S-REIT, currently it's about 6% returns. The regional REIT ETF, which sorry. Okay, I don't think that's a question. So I shall continue. So for those of you who in fact want to access REITs beyond Singapore listed ones, we do have two ETFs that allow investors gain exposure into the regional market like Australia REITs and Japan REITs, right? So if you look at the table on the bottom right, sorry, the affiliate APAC REIT will have exposure into Australia, Hong Kong, whereas the UOB APAC Green REIT have exposure into Australia, which is close to 40%, Japan and Hong Kong. And you can see that the last 3 months, in fact, UOB APAC Green REIT has outperformed the other pure S REIT and AXJ REIT. So this is again another reason why investors may want to seek diversification, so that not only for the long term, but for the short term, you will get a much more average diversified returns from your portfolio. So last but not least, it's a long list that we are trying to run through, but we do have a stock screener on our website. So through the screener, you can then filter down by asset classes, geographical focus, and from there it makes your life easier in selecting the ETF that you may need. You can also filter by those that pay dividends, those that doesn't pay, to meet your investment needs. So to get started, I think there are a few ways to start investing into ETFs. With email assistant, I am sure probably you can seek him for advice on what's the most efficient way to start. But personally, I think it's a journey to invest into ETFs. A lot of investors would want to go after a regular savings plan or robo-advisors, but the end game is really for each investors to have the ability to understand ETF itself and able to do a DIY investing to reduce the cost over time. But beyond that, I'm open to questions. I think we have probably come to the end of the sharing session.
Yeah.
Yeah.
Okay, thank you so much. So please key in your questions onto the chat. We only have about 15 minutes to ask questions. So I got one question here from one of the members. I think he want to clarify on the SRS part. So
Mm,
can feel free to add, but I think what I've understood for question is what are the ETFs that is available for SRF, and how they go about using SR to buy ETF. I'm not sure you can share a bit there. Yeah.
sure, sure. So all ETF are eligible under SRS. CPF list is shorter. There are only 6 ETF under CPFIS, which are the 2 STI, the 2 Singapore bonds, gold, and also Asia X Japan REIT. But for SRS, all ETF are eligible, which is why you look at our filter here. We don't have a SRS filter because everything is eligible under SRS. And how do you go about doing it? It depends on your broker. But typically the broker will have a settlement mode when you try to execute a trade. So that settlement mode should allow you to choose CPF. If it's not there, it means that you may need to link your CPF account, or rather a CPF investment account for agent bank to that broker, which I have tried with a few brokers. It should be quite an easy process. If not, the best person to ask will either be email or the broker.
Okay, thank you so much. Ken, feel free to add in if I didn't get your question correct. Okay, the questions are coming in already. So there's one from CW Tan. Is there a Nasdaq ETF listed in SGX?
Currently, we have Dow Jones, we have S&P, but thank you for the feedback. In fact, we love to hear that. Do let Yiming know if there's any ETF that you want to see. We are keen to bring in more of such US ETF on SGX. But for now, no, we have Dow Jones, we have S&P. Good to know that there is interest in Nasdaqs.
Okay, the next question is this. Other than the cost, what would be the advantage of investing in ETF rather than mutual funds like AIA or others? ETF also managed by professional fund managers as well. Thank you. Yeah.
Yeah, sure. So we go back to the benefits of ETF, right? We were talking about there are really 3 key benefits. So cost is one thing for sure. I think in today's world, a lot of investors also want transparency, right? They want to know what they are investing into. ETF is fully transparent. If you are investing into S&P 500 on a daily basis, you know what are the 500 companies you have access to. If you are buying to STI, you know the full 30 companies. You have transparency in terms of the pricing you're getting in real time as well, because you want to know what's the price you're executing it in it. And you don't have to wait for days to subscribe or to redeem, right? Many times when I sell my mutual funds, it would take about 3 to 5 days, depending on the company, and depending is an insurance link or not. It may take a couple of days for you to realize the proceeds. But ETF, because it trades like a stock, you will get it in T+2. And in fact, for most broker, if you have sold this counter on ETF, you can immediately deploy or invest into another ETF of different investment nature or geographical region. So that's really the timeliness of you receiving your money to reinvest into another market. And last but not least, just to share a bit of story on why ETF, besides low cost, has gotten so popular. In its previous shell is more of an index fund, right? Those of you who read the book by Jack Bogle, you will probably know that he's a strong advocate of index fund. And why index fund? Because a lot of analysis has been made, and one thing they found out is that in a very efficient market, in particular US market, it's quite hard to beat the market because information is very efficient, free flow of information, market is efficient. That results in the challenge of active fund managers to beat S&P over time, right? I think there was a famous story, or it's not a story, but Warren Buffett did really challenge whether the hedge fund managers would beat S&P over a period, and he won the bet. They didn't beat S&P. So you can see that active manager especially in developed market, where market is very efficient, it's not easy to choose the right managers, right? Not saying that there isn't, there will be, but just that the odds of choosing the right managers who can actively manage your portfolio is not easy, which has aid in the proliferation of index investing, and because ETF is then a more superior wrapper than unit trust, based on the few reasons I have laid out, it is really garnered the interest from investors who wants to have the full autonomy, full transparency, and the efficiency to invest.
Okay, thank you. Next question from Charles. Do all ETF pass all the dividend coupons payment from the underlying share bonds to investors?
It doesn't. So there are two forms of structure. One is distributing, one is accumulating. So accumulating is definitely means that they just reinvest any dividend or coupon or interest they receive from the underlying bonds or stock. They reinvest. They'll buy more stocks. They'll accumulate the returns, compound the returns for you. For those that they do distribute. They may not distribute as soon as they receive it because it depends on the dividend payout frequency. Some of our ETF pay 4 times a year, some half a year, some once a year. Dow Jones, interestingly, that's the only ETF that pays a monthly dividend. So they would need to streamline, like kind of accumulate some at some point and give out over a frequency. And there might be fees deducted as well from the dividend, right? That's how the management fee been charged. Typically they may deduct some dividend for management fees and to give the net dividends back to investors.
Okay, a related question from Andrew. So does it pay dividend like stocks in cash? So the keyword here is it pay like cash to investors just like the stocks does? Yeah.
It does, it does. So if you look at your CDP statement, if you look at your broker statement, there will be a corporate actions, cash dividends, and so it's just like stock, no difference in terms of the way they pay it. In fact, the rules that govern it, the record date, the XD date, the announcement date, it largely follow what is needed from a typical stocks dividend payment.
Okay, another question from CW. For ETF that track foreign shares, example Hong Kong, China, USA, do we have to pay withholding tax?
It will be at the fund level where they have already deducted the necessary tax. In Singapore, we don't have a withholding tax. We don't have a formula for any capital gain tax either. So if anything, the fund itself will have taken care of the underlying market tax. One exception maybe S&P 500, right? Just to be very upfront as well, is a US listed ETFs. So when your broker give you dividend from SPY, which in Singapore the ticker is S27, they will have deducted 30% withholding tax from it. Yeah.
Okay, next question from Charles. What caused ETF tracking error against the respective indices?
So for passive ETFs, the manager is not compensated for research, right? Because they don't try to beat the market. So what is the portfolio manager role then? It is really to track the market. So tracking error has the skill of the manager, how well they can deploy the money and make sure that they follow the index closely. At times when there is large inflows and outflows, how do they mitigate any cash drag on the performance of the basket, the execution of the underlying, right? So that is really a test of the manager skill. And sorry, let me sorry, Yimin, can you repeat the second part of the question again?
Okay, second part. Yeah, it's just about the tracking error lah. What causes the tracking error lah against the indices? I think what she's trying to say is how come ETF meet certain price? Like I think just now you show like STI today maybe only about 3008, but the I think ETF price is rated up $4.
Yeah. Okay. So two things to take note, right? I think that
Mm,
I recall what I wanted to share. There are two things to take note. One is tracking error. One is tracking difference, right?
mm,
For most ETF, there will always be a tracking difference, and the difference means that is the portfolio returns against the index returns. Index returns is typically higher because index don't have any fees, don't have any charges, don't have any depending on the type of index. Some index don't even take into account the tax that is payable. So your fund portfolio returns, you will need to take into a couple of factors, and the main one is the management fee. So in the ideal world, your benchmark returns and your ETF returns, the differences should be the tracking error, right? Because that's what they told you upfront that they'll be charging you. But then again, it depends on how easy it is to buy into the market. For markets like US market, Hong Kong, even Singapore STI, the tracking error shouldn't be big, really. It should be quite small. But for markets like India, for markets like emerging market ASEAN, because of the access of the market, the capital gain tax of the market, because of the number of, let's say it's a quite a diversified market access, tracking error might be bigger because of the complexity in for them to deploy the funds. But not saying that they are bad skill, it's just the nature of the market. And because you are investing into EM market, you may need to factor in some of these challenges.
Okay, thank you so much. Another question from Anne. It's more about the liquidity lah. So I
Mm.
think, so probably I think it's asking, do they have enough liquidity or is there like a market maker for ETF as well?
So there is always at least one. In fact, most of the ETF listed on SGX have two market makers. So unlike stock, which is not by regulations, they may not need to have a designated market maker, but by regulations, each ETF need to have at least one DMM. Most of them do. Why two? Because the issuer wants to make sure that in the case one is out, the other one is there. And their spreads do overlap. So that kind of increase the order book depth and improve the bid-ask spread as well. So which have narrower bid-ask spreads. Typically the direct market access, the single market like Singapore Hang Seng Tech, for example, Gold ETF, Singapore bonds, right? S-REIT in particular, the simpler, easier to access, more popular ETF. If you are trading on your trading platform, this will reflect the much narrower spreads. That being said as well, ETF typically will say is as liquid as the underlying market. So you don't expect the price to spike because of excess buying. The market maker has the ability to create new units. So if there is excess demand for, say, STI on a given day, the market maker is able to keep their quotes around the net value because they can always create more units to sell to investors.
Okay, question for Hock Ming. I hope I get it correctly.
Mhm.
So of course, he thank you for the overview of ETF. He asked whether if there's plan by SGX to introduce more equal weighted ETF, as most of the index type of ETF are market weighted. So I'm not too sure whether uh
Good to know. I'm not sure if Hock Ming will be keen in a equal weighted STI ETF.
mm,
Good to know about that. But I understand maybe this is coming from the recent popularity of equal weighted S&P 500. In fact, we do see the ones recently listed by the issuers in overseas market has gained quite a bit of traction. Again, this is something that we want to know more about. So do give us your feedback. As of now, probably on our market there isn't one that's equal weighted, but this is a feedback that will reflect to our issuer since we do hear demand from your side. Yeah.
okay, one last question. So
Mm.
Ken was asking whether we can share the deck and link so they can revisit. Ken, this part will be recorded. And of course, as usual, sent to you. So of course, thank you so much, Wei Jin, for allowing us to record and send. So I don't know, Wei Jin, would you like to send more information to them, or is there any way
Yeah,
you?
I mean we have a quarterly
Mm,
report, Q1
yeah.
report. I think that's the one that we can circulate to all the audience.
It's actually available on the SGX website, right?
Yeah, it is. It
Maybe
is.
if you don't mind, just show a very quick demo where they can access, and then
Yeah, sure. Let me just put up the share the screen again. Give me 1 minute.
yeah.
Should be done quickly. Okay. So I'm sure most of you are familiar with this page.
Yes, we are. Yeah.
our spring pricing page. If not, if you're at sgx.com, you will go to securities. Under research and education, go to sectors. This is where we will post most of our ETF highlights. More information can always be found the quarterly highlights. For example, the one on Q1. So by end of June, we will be publishing Q2 highlights. Beyond that, we also have sector reports, Gold ETF, China ETFs, REIT ETFs, right? So if you need to know more information, do feedback through email so that we can also along the way increase the kind of materials we put on our website. Yeah. So if you are Googling, just put SGX sector reports, you probably would be able to see that link. Yeah.
Okay, thank you so much, everyone. Of course, thank you so much, Wei Chin. I think that's all the time we have. So really, everyone can just join me and give Wei Chin a round of applause. I think there's some typing button somewhere, or either that, don't mind, just give me some thumbs up
Thanks a
button
lot,
on the
Yiming.
chat.
And yeah, look forward to meet you guys if there's